There's a specific number that separates successful investors from people who struggle their entire lives with money. It's not about how much you earn. It's not about luck or connections or being in the right place at the right time. It's a dividend milestone that 97% of people never reach. And once you understand what it is, you'll start seeing it everywhere. The people who reach this number experience something that most people never will. They stop being dependent on their paycheck. Their investments generate enough income that if they wanted to walk away from their job tomorrow, they could because the money is doing the work instead of them. My name is Ian, and for the past 15 years, I've watched people build wealth in completely different ways. Some chase stocks, some flip real estate, some start businesses. But the ones who reach this specific dividend milestone do something different. They build a machine. And once that machine is built, it runs whether they're working or sleeping, whether the market is up or down, whether they're paying attention or not. Today, I'm going to show you exactly what this milestone is, why 97% of investors miss it, and most importantly, the specific system that gets you into that 3%. Here's what most people get wrong about investing. They think it's either all or nothing. They believe you either make yourself rich through some spectacular move, or you stay broke forever. They're waiting for their big break. They're hoping to pick the right stock. They're chasing the hot sector that's going to explode. Meanwhile, the people who actually build lasting wealth aren't waiting for a breakthrough. They're building something completely different, something so mechanical and predictable that it works whether the market is exciting or boring. The dividend milestone I'm talking about is the point where your dividend income exceeds your living expenses. That's the number. That's what separates the 97% from the 3%. When you reach that number, money stops being something you have to earn and starts being something that's generated automatically. Think about that. Your investments are paying you to own them. You're not selling anything. You're not timing the market. You're not making risky moves. You're literally getting paid a stream of income just because you own pieces of companies that are profitable and willing to share those profits with you. Most people have never even calculated this number for themselves. They have no idea how far they are from that milestone because nobody talks about it. Financial advisors talk about retirement accounts and diversification and risk tolerance. Investment accounts talk about returns and volatility and beating the index. But almost nobody talks about the point where your passive income exceeds your expenses. And that's exactly why this milestone is so powerful, because once you understand it and start building toward it, everything changes about how you invest and how you live. The people in the 3% aren't necessarily richer than the 97%. Some of them are actually earning less. The difference is what they did with what they earned. They became obsessed with one specific metric. They wanted to know how much their portfolio was paying them every single year. Let me break down why this threshold matters so much and why reaching it is so fundamentally different from everything else people try to do with money. When you're working a job, you're trading time for money. That's the basic exchange. You show up, you work, you get paid. It's straightforward, but it's also limiting. You have a fixed number of hours in the week. You can only work so much before your body gives out. Your income has a ceiling because there are only so many hours you can trade. But when you own dividend-paying investments, something completely different happens. Your income is no longer tied to your time. You could be on vacation, sleeping, or doing absolutely nothing, and your investments are still generating income. This isn't theoretical. This isn't some future promise. When you own a dividend-paying stock or fund, the company literally sends you money for being an owner. The amount doesn't change based on how hard you work or how much time you spend thinking about it. It changes based on how much you own and how much that company profits. The reason most people never reach this milestone is because they don't understand the mechanics. They think it's some distant goal that requires incredible wealth. They imagine you need $1 million invested before you can live off dividends. But that's not accurate. It depends entirely on what your living expenses are and what dividend yield you can achieve. Someone living on $3,000 a month with a 4% dividend yield would need $900,000 invested. Someone living on $2,000 a month would only need $500,000. Someone living on $10,000 a month would need $2.5 million. The number scales entirely to your lifestyle and your tolerance for that lifestyle. And here's where the psychology gets interesting. The people in the 3% realize something that the 97% never figure out. They realize they could control both sides of the equation. They could lower their living expenses and simultaneously increase their investing. That combination creates a compounding effect that's absolutely devastating to poverty. When you lower your housing costs, your transportation costs, your food budget, and your miscellaneous spending, suddenly you're investing significantly more each month. And that larger investment base generates more dividends. And those dividends accelerate your compounding. You're not just saving more, you're building a machine that's getting faster every single year. Let's talk about what actually happens on the path toward this dividend milestone because it's not as slow as people assume. Most people think it takes decades to reach meaningful income from dividends. They're partially right, but only because they're not thinking about it correctly. If you're starting with a small amount and investing slowly, it takes a long time. But if you're thinking about it differently, if you're architecting your life around reaching this milestone, the timeline changes dramatically. Imagine you're 30 years old and you decide you want to reach the dividend milestone by the time you're 50. That's 20 years. You need to figure out what your ideal living expenses are in retirement, calculate the dividend income required to support that, and then work backward to figure out how much you need to invest right now. Let's say you want to live on $40,000 a year in retirement. With a 4% dividend yield, you'd need $1 million invested. From age 30 to 50 is 20 years. If you can invest $30,000 per year, that's $600,000 of your own money contributed. With compound growth at around 7% per year, your portfolio would grow to just over $1 million. You'd hit the dividend milestone right around age 50. That's not 40 years of grinding, that's 20 years of focused, intentional investing. But here's what's crucial. You can't reach that if you're living like everyone else. You can't reach that if you're spending 70% of your income. You can't reach that if you're lifestyle creeping every time you get a raise. The people in the 3% make intentional choices about their lifestyle that everyone else thinks are strange. They see a situation where they could upgrade their housing and they choose not to. They see friends buying new cars and they drive reliable used vehicles. They see coworkers taking expensive vacations and they take free or low-cost trips. And everyone around them wonders why they're not living the lifestyle they can afford. But the people in the 3% understand something everyone else is missing. They understand that every dollar they don't spend today is a dollar that's generating income tomorrow. They're not depriving themselves, they're not living miserably. They're making choices. They're prioritizing something bigger than immediate gratification. They're prioritizing freedom. The actual mechanics of reaching this milestone involve understanding how dividends work and how compounding accelerates them. Most people hear the word compounding and they think it's some magical mathematical concept that only applies to huge amounts of money over huge amounts of time. But compounding is actually very mechanical. When you invest $1,000 in a dividend-paying fund that yields 4%, you earn $40 in the first year. If you reinvest that $40, now you have $1,040 earning 4%. That earns you $41.60. Year 3 earns you $43.20. Each year, the amount you earn goes up, not because you're investing more money, but because you're earning money on your money. That's compounding. Now extend that to a real scenario. Let's say you start with $50,000 and you invest $500 per month. That's $6,000 per year. You're investing in quality dividend funds, yielding around 3.5 to 4%. All dividends are reinvested automatically. You're not touching the money, you're not spending the dividends. Year 1, you invest $6,000, and your starting balance earns roughly $1,800 in dividends. Your portfolio is now about $65,800, and those dividends are reinvested. Year 2, you invest another $6,000, and now your entire base earns $1,800 plus a little bit more because your base is bigger. By year 5, you've invested $30,000, but your portfolio is closer to $75,000 because the compounding is adding value even without your contributions. By year 10, you've invested $60,000 of your own money, but your portfolio is around $115,000 because the compounding is doing visible work. By year 15, you've invested $90,000 of your own money, but your portfolio is closer to $170,000. By year 20, you've invested $120,000 of your own money, but your portfolio is approaching $250,000. That dividend income at that point is generating close to $10,000 per year. That's roughly $800 per month that you're not earning from your job. That's a second income stream. And here's the part that breaks people's heads. You did that with consistent, boring, mechanical investing. You didn't pick individual stocks. You didn't time the market. You didn't need special knowledge. You just needed to stay consistent and reinvest everything. Now, let me give you character scenarios because people understand themselves in stories. Let's follow 3 different investors over 15 years. Sarah invests $400 per month. Mark invests $1,000 per month. Jennifer invests $2,000 per month. They all invest in dividend-focused exchange-traded funds, yielding around 3.5%, with dividends growing at 2% annually and the market growing at 5% annually. After year 1, Sarah's portfolio is around $5,000, generating roughly $170 in annual dividends. Mark's is around $12,500, generating $430. Jennifer's is around $25,000, generating $860. None of these numbers are exciting yet. This is where most people quit. By year 5, Sarah's portfolio is around $32,000, generating $1,100 annually. Mark's is around $80,000, generating $2,750. Jennifer's is around $160,000, generating $5,500. Mark is now earning enough to cover car insurance. Jennifer is earning enough for monthly groceries. By year 10, Sarah has $72,000, generating $2,600 annually. Mark has $180,000, generating $6,500. Jennifer has $360,000, generating $13,000. Mark's dividend income is roughly $500 per month. Jennifer's is over $1,000. By year 15, Sarah's portfolio is around $120,000, generating $4,300 annually. Mark is around $300,000, generating $10,700 annually. Jennifer is around $600,000, generating $21,500 annually. Jennifer's dividend income is roughly $1,800 monthly. Mark is at $900. Even Sarah is at $360 per month. All 3 followed the same system. The only difference was monthly investment amount. Sarah reached meaningful income that continues forever. Now let me address what actually breaks people, because the system is simple but not easy, and the obstacles aren't mathematical, they're psychological. The biggest mistake people make is panic selling. Someone invests consistently for 3 or 4 years, then the market drops 20 or 30%, their account value shrinks, and they panic. They sell to protect what's left, and they lock in losses. They destroy the compounding. But here's what the people in the 3% understand. When the market drops, the dividend-paying companies don't stop paying dividends. If you own quality, the income keeps flowing. And those lower prices mean your reinvested dividends buy more shares. A market crash while you're still investing is actually a gift. Your contributions and your reinvested dividends are buying at discount prices. But panic makes people sell instead of continuing. The second biggest obstacle is lifestyle inflation. Someone raises their investment to $400 a month. They're on track. Then they get a $5,000 raise at work. Suddenly they upgrade their housing or their car or their lifestyle slightly. Their contributions stay at $400 instead of increasing to $800. They just added 5 years to their timeline without realizing it. They chose the car over the freedom. The third obstacle is the boredom of the process. The numbers are small in the beginning. The dividends feel insignificant. People want something more exciting. They want rapid growth. They want to see dramatic results. So they jump into riskier strategies, try to pick individual stocks, follow hot tips, and they get destroyed. Meanwhile, the person who stayed boring, who kept reinvesting, who didn't try to get rich quick, is building real wealth. The fourth obstacle is that the culture around you doesn't support this. Friends and family think you're cheap. They don't understand why you're not upgrading your lifestyle. They don't see the system you're building. They see deprivation. And if you're not strong psychologically, their judgment gets to you. You start spending to prove you're successful, You destroy the machine while it's still small and fragile. The people in the 3% solve these obstacles through systems and mindset, not willpower. They automate their investments so the decision is made before they feel tempted. They build a community of like-minded people, so they're not isolated in their choices. They focus on cash flow metrics instead of account value, so they're not demoralized by temporary market drops. They celebrate small wins, like their first $100 in annual dividends, because they understand the timeline. Let me give you the actual system that gets people into the 3% because it's mechanical and replicable, and it works regardless of your starting point. First, calculate your target dividend income. How much do you want to live on annually? Let's say $36,000 per year. At a 4% yield, you need $900,000 invested. That's your milestone. That's what you're building toward. Now calculate what you can invest monthly. This is where most people get it wrong. They say they can invest what's left after spending. Instead, automate your investment first before you see the money. Pay yourself before you pay everyone else. Set up automatic transfers from your paycheck to your brokerage account. The amount doesn't have to be huge, it has to be consistent. Even $300 monthly compounds into serious wealth over a 20 years. Second, choose quality over yield. Don't buy dividend stocks yielding 10%. The yield is usually high because the stock is cheap for a reason. Buy boring companies that have paid increasing dividends for decades. Buy dividend exchange-traded funds that filter for stability. Buy quality that can survive recessions and still pay you. The yield might be 3.5 to 4%, but it's reliable. Third, reinvest all dividends automatically. Don't spend them. Don't let them sit in cash. Set up dividend reinvestment plans so every payment automatically buys more shares. This is where the magic happens. Your money is earning money, and that new money is immediately earning money too. Fourth, don't touch the portfolio. This is the non-negotiable part. If you start withdrawing, you're stealing from your future self. You're interrupting compounding. The portfolio stays intact. You're building something for later, not today. Fifth, ignore the noise. You'll hear about market crashes and recession fears and the next crash coming. You'll see your account value drop. You're not listening to noise, you're focused on one metric. Is the dividend still being paid? If yes, you're fine. You're actually better off because you're buying more shares at lower prices. Sixth, measure progress by cash flow, not account value. Stop checking your portfolio daily. That will drive you crazy. Instead, check quarterly. Instead of asking how much is it worth, ask how much did it pay me? When you shift that focus, your emotions calm down. You're measuring progress by a stable metric instead of a volatile one. The quarterly dividend report becomes your motivation. You see the $100 becoming $200, becoming $500. That's real progress. Now let's get real about the timeline because this is where expectations collide with reality. If you're starting from zero and investing $400 a month, reaching a dividend income of $3,000 a year takes roughly 12 to 14 years depending on market conditions and dividend growth. That's when you're earning roughly $250 monthly passively. That doesn't sound huge, but in another 5 years, that's doubling to $500. In another 5 years, it could be closer to $800. The speed compounds. Year 15 feels slow. Year 20 feels fast. This is why people need patience. The first few years feel like nothing is happening. By year 10, you're starting to see real income. By year 15, you're experiencing meaningful cash flow. By year 20, you have options. You could live off your dividends. You could keep working and accelerate. The people in the 3% understood this timeline before they started. They weren't expecting miracles in year 1. They were building something for year 15. And this completely changes their emotional experience of investing. They're not disappointed when their account grows slowly. They expected it. They're celebrating when their dividend income hits a new threshold. They're emotionally aligned with the actual timeline instead of fighting it. This is why so many people fail at investing. They expect miracles, they get normal results, they quit. The 3% expected the timeline. They got exactly what they expected. They continued. Now here's something most people miss about this system. It's not dependent on your income level. Someone making $60,000 a year can reach this milestone. So can someone making 200,000 a year. The difference is the timeline. The lower income person needs to lower expenses more aggressively, invest a smaller absolute amount, but a higher percentage. The higher income person can invest more in absolute dollars. Both can reach the same milestone. Both can generate the same dividend income. It's about the percentage of income you invest and how consistent you are. The mechanic works at any income level. It just works faster at higher incomes. This is why I keep saying this isn't a rich people thing. It's a discipline thing. And discipline is available to everyone. If you understand this dividend milestone and you want to reach it, the implementation is straightforward. Pick your monthly investment amount, commit to it, automate it, choose quality dividend funds or stocks, set dividends to reinvest, stop checking daily, measure progress quarterly by dividend income, stay with it through market drops, resist lifestyle inflation when you get raises. That's the system. It's not complicated. It's not exciting. It's mechanical. And that's exactly why it works. The people in the 3% aren't smarter than you. They're not luckier. They're not special. They just understood that building an income-generating machine requires consistency, patience, and a willingness to stay boring while everyone else is distracted. If you implement this system, in 5 years, you'll have a real dividend stream. In 10 years, you'll have genuine passive income. If this framework makes sense to you and you want to understand more about building real wealth through dividends, make sure you subscribe to this channel and hit that like button.